This is Real Generational Wealth. Live from Southern California, this is Abby, Espy, and Jen.
Hi, happy Wednesday, everyone.
Happy Wednesday, everybody, and welcome back to Real Generational Wealth, where we have over 50 years of combined experience making sure you and your family always have a place to call home. Today, we have a very special topic for you guys. We've gotten a lot of questions about this. Taxes. It is tax season. I know all of you guys are getting all of your paperwork together, trying to figure out what tax breaks you can get. So today,
This is Real Generational Wealth.
We have a special guest, CPA. He's going to talk about all the tax benefits you get for being a homeowner. So if you're watching us live, be sure to hashtag live. And if you're catching us on the replay, hashtag replay. But before we get there, wanted to check in with you ladies. How's your day going? How's your week going? How's the market? Not like it's much different from it has been. What's going on with you guys?
For me, it's busy, but I'm kind of taking it easy this week because it's my dad's death anniversary on Sunday. So I'm just, just not working too much and then just cooking at home. I have a couple of closings in the next week or so. So I'm just, not too active. Yeah.
Good.
How about you, Espy?
Breathing. Well, yeah, it's a circus. So working two markets here and the Northern California, I have a lot of driving and calls and following up different markets. So, we complain about no inventory here, and in the Bay Area, it's worse. Like in
really?
one city, there's only like 7 houses available, single family homes. So how can you? But yeah. Anyway, I think we have to be grateful because the market is still alive, and there's still people who wants to own a home, and the rates are in their favor.
Definitely.
Yeah. So I'm also developing some new clients here, and doing some new marketing strategies. So I've been busy, and
Awesome.
the two of you are a lot younger, and I say to myself, oh my gosh, I wish I can do all the calls. I say to myself, I can make like 25 calls easy a day.
Yeah.
So, if you make 4 or 5 calls that are productive, then that's good enough for me.
Sometimes too, you can get stuck on the calls just catching up with
Yes.
clients, right? You can get
That's
stuck
true.
on it for a couple of hours.
Yeah,
So
you don't even realize.
yeah, you don't even realize it's like time's going by so fast.
Yeah. How about you, Jen?
Today has been a day. I feel like I've been running around like a headless chicken this past week. But I mean, it was all good things. Got kind of like what you said. I still remain grateful. Today, I was able to. We listed 2 new listings. So 2 new listings today. Opened escrow
Where?
with their listings.
Nice.
So 2 escrows.
Mhm.
But then on the flip side of that, I had 2 buyers that got rejections today. And so the ups and downs and this roller coaster of emotions in real estate, it's kind of something that we do. We hop on this with all of our clients. And even though there's this up and down, I want to piggyback off what Abby said. Sometimes it's important to breathe, and take a step back and check in with ourselves to make sure that we're good,
Yeah.
But yeah, I mean, otherwise everything's been good. I'm super busy, super blessed, super thankful.
Where are your listings at? By chance?
One listing is in Playa Vista, right close to Marina Del Rey. 4
Nice
beds,
area.
3 baths,
Right?
completely remodeled, basically a modern home, 1,800 square feet for 1.5.
Mhm.
And then we also have a condo in Agora Hills on Thousand Oaks Boulevard, 3 bed, 2 bath, about I think It's 1,100 square feet for 430. So
430.
two ends of
Wow.
the spectrum.
That's really good.
Spectrum.
Yeah. I mean, I was going to say everybody's selling. No, we definitely have more buyers, but people are finally starting to come around. They're saying,
Yeah.
hey, I mean, I can't
Mhm.
actually get good money for my listing, or my house
Yeah.
right now.
Well, this is the best time to cash.
Yes.
Yeah, this is a prime season for selling your home.
Yeah.
So
Mhm.
don't wait.
Yeah,
That's right.
definitely.
Mhm.
But for those who are already homeowners, we
Are gonna
wanted
be or future homeowners.
exactly. Well, future homeowners, we wanted to talk to you guys and help you guys learn about some tax benefits you can get. So that being said, we are bringing on a special guest today. Give me a second. Let me bring him on. We have Erick. There he is. Licensed
Hey,
CPA
Erick.
to answer
Hi.
all of your guys' tax questions. So what's up, Erick? How are you?
Good. First off, I want to thank all of you guys for inviting me to be part of your panel. Jen, Abby, SB, thank you very much. It's a privilege to be conversing with the three of you. And I always watch pretty much majority of your shows.
Oh, thank you.
Awesome.
Yeah, I'm a fan.
All right. All
Yeah,
right.
so yeah,
It's a
So
privilege
tell
to
us-
have you. I mean, we've kind of been wanting you on the show, so it's great that you're here today.
yeah.
So tell us about yourself, like your background and how you became a CPA.
Okay. So I'm a CPA for the state of California. I earned my bachelor's degree from California State Northridge. They actually have one of the top accounting firms in the nation. I've had my accounting office, Southeast Quality Tax, for 5 years now, which
Mhm.
is located in Panorama City, and which is the city that I grew up in. And I feel like I serve my community by opening up an office in the city where I grew up in. So there's a
Yeah.
lot of large concentration of Filipinos there.
Yep.
And
Yep, Panorama City.
yeah,
That's
and I
where
I love having all these Filipino places within striking distance of my office. So
there you go.
lunch, like what to buy for lunch, is never a problem.
Yeah.
Yeah. Also, I just want to plug into. I'm one of the co-founders also of SoCal Filipinos. All of you guys are members. I know. I just want to thank you guys also for being members of SoCal Filipinos.
Yay.
Yeah. Very
And
good.
yeah, I'm the co-founder with Jason Lastina. I just want to say I feel blessed to be part of that group and to be teaming up with the other SoCal Filipino moderators, Lily, Edmund, Diana, Kathleen, Erica, Catherine. And I just want to give everyone shout outs from that group.
Very nice. Yeah.
Hi guys.
Hello.
Yeah.
Must be watching
Okay.
us.
Yeah. Okay. So yeah, and any other questions about my background or I guess that's it, right? I think we get to the meat.
Basically, yeah.
So okay, so
Right.
one of the go ahead.
I was
Oh no,
gonna,
I was
okay,
gonna
so
say
I mean, let's just start with, the biggest question. Let's just say I'm a new homeowner.
Mhm.
What can I write off? Let's
What
start there.
can you write off? Well, one of the
New
first
laws.
things that
There's
yeah,
the
one of
new laws, right?
mhm. So one of the first things that you could write off is your property tax.
Okay.
The local taxes that you pay on your houses is a tax deduction. And just to clarify, a deduction actually reduces your taxable income. So just want to make sure people know the difference between a tax deduction and a tax credit. So when we say deductions, let's say for example, you earned $50,000 and then you paid $5,000 in property tax. Then it'll be 50,000 minus 5,000, 45,000 will be your taxable income because that's your deduction.
Mhm.
So I just want
so
to,
basically you're lowering your AGI when you have a deduction.
so basically you're lowering your taxable income. Yeah. Your
Okay.
AGI is separate. There's AGI and then your deductions and then your taxable income.
Okay.
Okay. Yeah. What lowers your AGI? It'll be a different show.
That's right. Yeah. The Schedule C.
Schedule C or a rental property could lower your AGI.
Yes. Yes. Yeah.
Oh,
So
that's
Well,
good to know.
while
For
we're
next
at that topic, I
Mhm.
just want to ask. I don't want to forget. You know how seniors are. Sometimes you forgot to ask questions. My question is that when I mentioned about a new law, I used to chant before that you can you can deduct your property tax and your mortgage interest. But
Mm-hmm.
right now, it's not all of that. There is a cap,
Right.
right?
Yes.
There's no cap. Yeah.
There's a cap of $10,000.
Mm-hmm.
And the cap, it's not just the property tax that you're paying. The cap is $10,000 of your, if you're a W-2 employee, any local or state taxes that you pay from your W-2 plus the property tax, there's a cap of that up to $10,000 that you
Oh,
can
that's
deduct.
terrible. Oh
Yeah.
my God.
So it's
For
not
us,
used to be that if your mortgage interest that you get at the end of the year from the bank is like $24,000,
mhm.
because your property tax was $5,000, you now have those two to deduct. No more, right? We don't have that anymore.
No, you could deduct your property tax and your mortgage, but then now there's a limitation on how much mortgage interest you could claim. I haven't seen it as an issue prior years, but I think it'll be an issue this year going forward because now there's going to be mortgage loans north of $750,000, right?
Right.
Yeah.
Because $750,000 you could claim any interest paid on an up to $750 mortgage. But since now I see houses being sold for $900, $1 million, most likely they're gonna have a principal mortgage of over 750. So any interest earned from 750 going up will not be taxable.
Mm-hmm.
I'm
Yeah.
sorry, will not be taxable, will not be a deduction.
Deduction, yeah.
Yeah.
Yes, yeah.
Okay.
So
Okay,
that's
so
one of the things.
go ahead.
Go ahead.
Okay,
I have a
I
question.
just wanted
Oh,
to, because you were just talking about property taxes, right?
Yes.
So I have a few buyers that closed in the last year, and they sent me a picture of their 1098 for which is the mortgage insurance, mortgage interest. Sorry. And let's say they're watching our show right now, and they say, "Oh well, hey Jen, how do I? Oh, where did Abby go? Her video went out.
You lost Abby.
Oh no. Okay,
She's
she'll get back on.
lagging.
But
She will just lag in.
like let's say they asked me, "Oh Jen, I was watching your show, and Eric just mentioned." Oh, there she is.
sorry, I got kicked out.
Hey, welcome back.
Property taxes. How do I know how much do I write off? Because my property taxes are currently built into my loan.
So usually it says on your 1098, it would say it there.
Okay.
If it's not there, you would also get a statement
Okay.
from the assessor's office. You would get that. And then if, let's say, for example, some clients, they forget those two information, it's not there, then we go log in the website, like, for example, Los Angeles assessor's office. If you had your information, you could access, how much taxes you paid for the year.
Mm-hmm.
And it would be there. Yeah.
Cool.
I have a
So
question.
even if you are, I'm sorry, Abby. Even
It's
if you are just doing it yourself, then you can go to the county assessor's office, type in your address, and it's gonna show up there, right?
Correct. Yes.
Yeah.
Yeah. It would have some questionnaires in there to make sure that you are the homeowner.
Right.
So,
Yeah.
so yeah, then you'll be able to pull that information to see how much you paid.
Mm-hmm. Okay.
Mm-hmm.
All right,
And
Abby.
Okay, I just had a question. For your property taxes, can you write off Melrose?
that one I'm not too sure. I'll have to check on that one.
Okay.
Okay, but I'll verify that one because I'm not sure if it's built in or if it's separate. I've never come across it yet.
Yeah, because sometimes they say, "Oh, it depends on what it's for. Like, is it
Mhm.
for,
Improvement.
the police station, or is it for the water or the school, something like that?" But
Makes sense.
yeah.
But it says, let's see. Yeah, you're right. There are conditions that need to be met for it to be tax deductible. So correct.
Mm-hmm.
Okay, and then
Yeah, just
also,
like with anything. Okay, good.
there's a new law regarding accelerated capital improvements. Can you expand on that?
I can't expand on that right now because I haven't done my research on it.
Okay.
Yeah,
'Cause
sorry
I know
about
it's
that.
new. It's something.
Yeah.
It's something new that one of my colleagues told me about.
Yeah, because this tax season is way different than any other tax season that I've had
Right.
so far, because like legislation has changed in the middle of tax season. So then we were like trying to get updated with what's new. For example, beginning of the year when we were filing people's taxes, all of the unemployment that you receive are all taxable. Then in the middle of tax season, they go, "Oh, wait a minute, 10,200 of that is not taxable." Then we have to change it.
Right.
We kind of have to change stuff again. So I feel like tax season this year is a moving target. So anything
Yeah,
new just becomes oh, you know what? Oh no, now we have to like make some amendments or whatnot.
that's probably why they extended it, right, for another month.
Yes, for May
May
17, which
15th.
I felt
Oh,
like
May 17th.
yeah, I felt like it just increased my stress. Just kidding.
That's good though. It's
Thought
good
you're
to be
going to have a
busy.
vacation on April
Yeah,
16th, huh?
yeah. So May 17, yeah. And then aside from that, like the common deductions from Schedule A are the property tax, mortgage interest, points that you paid. But then, of course, the points that you paid, there are restrictions or limitations on it, and also the PMI, which there's also limitations and restrictions on it. Not like before; it's kind of like almost you just deduct everything, but now there's limitations.
Mm-hmm. Mm-hmm.
Oh, okay. And then I think a lot of people are wondering how are the stimulus funds taxed?
So the stimulus are not taxed. They are not considered taxable income. They're considered kind of like a credit. So, for example, for 2020, if you didn't receive any of the stimulus funds or you didn't qualify for it, because they base it off the 2019 where, for example, you
Mhm.
made over the
Income.
threshold,
Yeah.
yeah, over the cap. But then in 2020, you made less than the cap because of the unfortunate pandemic.
Mhm.
Then what will happen is when they file taxes, they will get that as a credit. They are gonna get like if they miss that on the 1200 and the 600, they'll be able to get that.
Mm-hmm.
Okay.
Mhm.
Okay, that's good to know.
Yeah.
That's good.
Yeah, that's why some people are kind of like, okay, you know what, we made under, we want to make sure we file so that then we qualify for the third, because there was a third one that came in the middle of the year, right? I mean, middle of tax season.
Right.
Yeah.
Mhm.
Okay, so we have a question from Oliver. He's
Sure.
asking if I have solar equipment paid through government program like PACE, is that tax deductible?
Did Oliver pay anything out of pocket?
Oliver, did you pay anything out of pocket?
Because
Let us
each
know.
situation is different. That's why if they have like a direct question like that, they'll have to they could just send me a message and I'll answer. Because the thing is, if it's, let's say, you paid out of pocket for it, then you could get up to 26% of what you paid tax credit.
Oh,
Right.
Okay.
Let's say it's $10,000, then you'll get $2,600 tax credit. And then next year, I believe it's 22%, and then the year after that, I think it's phased out. So if you want to get your solar panels, hurry up so that you can take advantage of the residential
but he didn't
energy
put any
credits.
money because
There
Oliver
we go.
answered no.
Okay.
That means no deduction then, right?
Yeah, because it would have been nice to get credit for something that you didn't pay for, right? I'm just kidding.
That's true. Because what if the
Yeah.
other person got the credit already? So you
Yeah.
would get the credit
Yeah.
twice.
Yeah.
Okay, if you ladies don't have any other questions, I have some more questions.
I mean, well, because we've talked about basically deductions you can take as a homeowner, right? When
Mhm.
you're owning the home and living in the home and you just bought the home, what deductions can you take on your primary residence once you sell it?
Yeah. So okay,
The cap
once you sell it,
gains. That's the big deal right now. The capital gains.
because I'm sure everyone's aware of the exemptions, right? The $250 and the $50,000. I'm sorry, $500,000
So for
exemption.
the sake of the audience, John,
Yeah, I was going to say we
Eric,
should explain
can
that for
you
the sake
So
of it.
can you describe
Yeah.
that again?
So I will describe it. So for example, if you sell your property and you have, you for $750,000 and it costs you $500,000, you could, let's say you're married, you have up to like $500,000 of capital gain that you won't be taxed, as long as that property meets like specific guidelines where you lived in the property for like 2 of the last like 5 years. Then you could take advantage of that. Meaning, you're getting this gain without being taxed. And then any gains after, let's say, if you're married, the $500,000, any tax after 500, you'll be taxed at any gains after 500. Sorry, you'll be taxed at about roughly 15%.
Only?
So it depends too. If you start making more money, then it could go up to 20.
Yeah, so it depends on your tax bracket at the time that you sell it, right?
Exactly. Yes. Total income. Yes. But
Right.
then those 20%, it's really the high earners that would get it. But then if you're earning, I believe, below 80K from what I can recall from the top of my head. It's at zero. So I'll have to check the exact number, but there's always all these limitations. That's always a moving target every year.
There's
Right.
always a formula. And I
Yes, there's
heard
always a formula.
I want to make sure if of what I heard is correct. So since you are CPA and we're talking about this topic, I have a client before that has gained. They bought the house for $185,000, and then
Mm-hmm.
now they're selling it for 1.5. So
Mm-hmm.
obviously, they've lived there for 30 years, and they have capital gains.
Mm-hmm.
So what I was told is that you have to document all the home improvement that you did, but then during that 30 years you were not realizing that you were just being parents and growing the kids and earning money, right? You were not really paying attention. So I heard that there is some kind of standard formula that they can use in lieu of that. So even if I made an improvement in the house where I added like square footage and all that thing and spent like maybe $500,000 on the house, but if I cannot document it, there's some kind of a standard that they can put there to help you, reduce the capital gains. Is that correct?
It's actually my first time hearing about that. I am not sure, but usually, yeah, I ask my client for, what are the basis or whatever they have documented. And then if not, I got so fortunate. My clients were able to come up with these calculations on increasing the basis. And one of the reasons why you want to increase your basis is it reduces your capital gains. So
Yeah.
the higher your basis is, then that means the less capital gains that you have. So it's always important, because for me, I guess because I'm an accountant, like trained that way, that every time I spend money, I like to document everything. I like to save everything. I like to save receipts, which is kind of like
Yeah.
annoys my wife. She thinks I'm like always hoarding paperwork.
Mm-hmm.
But then the thing is, with these things, especially like any big purchases or big spending, you always want to keep track of it.
Mm-hmm.
I suggest either scan your documents, save it in a folder, or
Mm-hmm.
something like that. Yeah, always important. And then because the thing is, you never know when times comes like this, you're gonna need it. And then usually for basis too, for example, if you added like an extension, I mean, you will still have paper trail on when you added that extension, because you apply for permit, right?
Mm-hmm.
There'd be like certain permits and stuff that you could also use, kind of like help backtrack for that information.
Mm-hmm. Mm-hmm.
So
Okay.
yeah. But then in terms of a formula for the basis, I'm not too sure yet.
Mm-hmm.
So we
So
have a
the
Because a lot
question.
of
basis is not necessarily the purchase price of the house when you bought it. That's not your
No,
basis.
no.
Okay.
So the basis consists of the original purchase price and then any improvements that you've made.
Hmm.
Ah,
Any improvements that you've made to the house increases the basis. For
I see.
example, you spent, you bought the house for $180,000, but you spent $20,000 updating the kitchen. Then now your new basis is $200,000.
Uh-huh.
Yeah.
Okay. Okay. So dollar for dollar, not the market value of that improvement that you
Oh yeah,
did.
Yeah. So how much you've spent? Yes.
Okay.
got it.
Yeah.
So we have a question from the audience.
Sure.
It's kind of an investment property question, but it's actually a good question on the second part of it. So
Sure.
let's say I do a 1031 exchange and then I turn around and sell the house. What taxes do I pay?
Okay.
Or can I convert a 1031 exchange from investment property to primary residence?
Okay. Actually, I thought the 1031 would be next year. I wanted to
I
do like
know.
an
Okay, so we don't have
animation
to
of this
answer
one.
this. Okay, but as far as can you
No.
convert the 1031 exchange from investment property to primary residence?
just
There's
live in it.
loopholes. Pretty much the loopholes. Yeah, there's loopholes in there. It's just pretty much to live on it. But technically, to take advantage of a 1031 is a like kind. So you got to get, you got to exchange it to, let's say, pretty much investment property to investment property. The only thing that you can do is, let's say, I'm not sure. I need more details on that one too. So if it's a residential, was it a rental? And then yeah, you're right. Abby said it best. Live in the house.
But
Yeah.
can't you do so single family residence? Can't you do isn't a like property a fourplex? Would that be considered like
Yeah.
properties, right?
Yes.
Yeah. So
So that would
yes.
qualify as a like property as long as it's not commercial or used for commercial purposes like such as in a shopping center or something like that.
No, you can also use that.
Yeah, as long as it's
As long as it's not a boat or a manufactured home, like a mobile home. I don't think that's not going to qualify you
What's the
for public home.
guideline on that? Like, how do you determine
Real estate.
what's
Real
light?
estate and
Yeah,
commercial
so
building.
pretty much any income producing property to another income producing property. It's kind of similar to the way I put it is the way when people move around their retirement accounts. So if you move a retirement account to a retirement account, there's no tax issue. But if you move a retirement account to a bank account, then there's like a dollar value issue that, there's some gains in there or some tax. So it's kind of similar concept, high level concept with like kind. So it has to be like kind and like kind. But then if it's like that like kind that you're exchanging, the asset is not what the IRS thinks it's not like kind, then it's not going to work.
Okay.
But then there's always gray areas. There's always exemptions of like how, people navigated around it and actually increased their wealth.
Yeah.
Okay.
Can I just
cover Jeopardy ones more next week? Okay.
Yes.
Yeah. I just want to mention who are watching us: Clarice Penafel, Malu Valdez, Fernando Almeida, and Oliver, of course, our Oliver, and Amy Bondoc. So we just want to thank you for watching us. Harry, Karahajan, Phyllis. Thank you for watching us, and hashtag live if you're watching us live, and hashtag replay if you're watching replay, and let us know where you are watching from. Oh yeah, and Veron is here too. So thank you for watching us. I hope that we're giving you all these little nuggets from Erick, our CPA today.
Yeah, and thank you. Just wanted to say I'm like really nervous. This is actually the first panel I've done.
Don't be nervous.
There you go.
I feel like I'm kind of blanking out here and there. I was like, oh my
No,
gosh.
relax, Erick. Don't worry. We just casual.
You're doing a great job.
Yeah,
by the
you're
way,
doing great.
so.
Mhm.
Yeah.
Okay, so we have a question
Sure.
about if we purchase a solar, the solar, is that tax deductible? I think we're going to get that question a lot.
Yeah, the residential energy credit, up to 26% of what you spent is a tax credit, not tax deductible. Tax credit meaning, let's say, for example, you got the example I used earlier was like $10,000, right? You get $2,600 credit, but you owe the IRS, for example, $5,200. Then you'll offset it there. Then it'll be, you'll owe, $5,200 minus $2,600. Pretty much, you cut your thing in half, or less than half. But, yeah. So there's a different. Yeah, they're different. When people say deductible and credit, I want to make sure. A deductible reduces your taxable income. A credit reduces your tax liability.
So everyone buy solar panels and get your electric vehicle.
That's right.
Yeah.
That's the topic we're going to have next week with Abby as one of our speaker.
That's actually a great topic.
FACCGLA.
Yeah, Phil Ann Chamber of Commerce.
Yeah, she's one of our sponsors actually, promoting her sustainable
living.
Sustainable living.
And sustainable lifestyle.
Right.
And if the new legislation's passed from the new administration, I think they're working on getting more tax credits for EVs, right?
Yeah. So my husband, he works for Rivian. I mentioned that before. Rivian is a new electric vehicle company. It's kind of like Tesla's competitor, and they have most of their vehicles are for outdoorsy people. If you want to go camping, you can camp in the back of the vehicle, and supposedly they have tax credits that are pretty significant so that it encourages people to buy their electric vehicles. So go look out for Rivian.
Because currently there's some tax credits in California, but not the federal. So
True.
Then,
yes.
And combine it with the federal, it kind of like more incentive to switch over. Yeah.
Plus, they're faster. Electric vehicles are a lot faster than gas guzzlers. No offense.
Less maintenance too, right?
Less maintenance. You don't have to get a tune-up. You don't have to change your oil. You have all the torque right there, and then you can just speed away at the stop sign or the stoplight.
Yeah.
It's fun. It's fun driving an electric vehicle.
You can drive in a 25-mile school zone.
That's true,
Yeah.
but it goes from like 0 to 60 in like 2 seconds, 2-3 seconds.
Oh, wow.
So yeah, I try to be careful in the school zones. Anyways, let's go back to the topic. Sorry to get off subject.
Fine.
Yeah.
Well, we do have another question, Eric. May I ask if he knows anything about foreign nationals and taxes related to them? So I guess if you have a foreign national that owns a home here, are they subject to any taxes or tax deductions they can take?
Where do they live? In the Philippines?
Well, let's say.
Let's just use that as an example,
Yeah.
since the majority of our viewers are from the Philippines.
I mean, if you are a U.S. citizen, you still have to file anyways. And then if you work, let's say in the Philippines and earn money there, any taxes that you pay there becomes like a credit here. So you're not really paying like double taxation. So yeah, but then I know there's a lot of like details into that, depending on like, let's say what kind of income they're getting from there, or are they getting income here? Are they getting SS here but then retired there and then they made money there or something like that? So there's a lot of like moving parts.
So basically, call you, right? Call you.
Basically, call me. Yes.
How about that?
Yeah, because it's gonna get complicated.
That's true.
I don't want to talk about like accounting too much and like make people fall asleep.
Yeah, actually, when you are a foreign national, and then so that is a foreign investor. You're talking to the as if it's a foreign investor. So if they buy or sell, then of course, just like anybody else, they're gonna be taxed. But
Of course.
the tax is always going to be different than the citizens, right? It's gonna be
Yes.
more. The
I'm
bottom
sorry.
line is that it's gonna be more.
Yeah, actually, my thinking was this person lives a U.S. citizen. The way I framed the question in my head was this person's a U.S. citizen that lives in the foreign country. I guess a foreign national.
The foreign
right?
national.
Yes,
Yeah.
yes, yes. Sorry.
Yeah.
Yeah.
So
yes,
I
go
just
ahead.
want to plug this in, and the thing is that at this time, if you notice, for the last 10 years, our value has going up, 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 and then during the time
Property
that
value.
we are going to that sweep up, so many people were investing, even foreign nationals were investing.
Yes. Of
So
course.
I think that the way I see it right now with the market, and the market is still good, I'm anticipating that there's going to be a lot of foreign nationals or even investors, local investors, who are going to be cashing out, you know, because the rates are still good, people are still buying. And then with all that, unseen future that we have with regards to all this multitude of millions of forbearance that is happening, as we speak, we don't know when the market is going to correct itself and how it's going to correct itself. But this is the perfect time to do your
Cash.
move up or move down, or things like that
Sell.
need to shift, right?
Yep.
And that
Yep.
means
So,
there's going to be more listings in the market. Yeah,
yeah.
which is good.
Yeah, it's good,
I have a
yeah.
question. Kind of going back to what we were talking about earlier. You were saying as a seller who wants to sell their house. I thought of the question because I know one of my sellers is watching right now. So the trick is to raise your cash, or was it the basis, right?
Yes.
The property basis of the
If you
property.
increase your basis, yes.
Okay. And you said things like improvements you've done to the property, you make an extension or anything like that. Moving expenses, are those, can we do anything with moving expenses?
Moving expenses used to be part of your deductions,
Okay.
but with the change in administration, that pretty much got wiped out. But
Wow.
selling expenses will reduce your capital gain, which such as commissions that you paid, if you have to pay any attorneys or any other costs associated with selling, closing costs. Yes, so those things will, because then moving expenses is different. But then I think for the moving expense, unfortunately, because that before it was deductible as part of your Schedule A, but not anymore.
Not anymore.
Your expenses, I think it depends on how you put it in the books, right? How you're gonna describe it in the books, right, Eric?
I'm just gonna go with like what it says on the IRS website.
Yeah. Yeah.
Okay.
So Harry has a question because I I also have a buyer buying with an LLC. Like we changed it during escrow, and they decided to put the home under an LLC. Like what are the benefits of buying a primary residence with an LLC?
So let's say for a primary, is it going to have a mortgage too, right?
No, it's cash.
Oh, it's cash.
I don't think
Well,
can you get a mortgage with an LLC? Well, I guess it kind of depends,
when,
but yeah, never mind.
yeah.
Okay.
So, but then if you have, for example, you have a business, right? I mean, you have an LLC that you paid the, you paid it, they own it. What will happen is you'll be able to claim, like, let's say for the property tax, for example, it's capped at $10,000, right? For residents. But then, this is owned by a business, right? For example, your rental property, you have a rental property that's under an LLC. Then you could claim the whole property tax because it wouldn't be subject to cap,
Oh, wow.
right?
So
Let's say
it's
property
like a
taxes, for
hack.
example. Huh?
Like hack.
It's like a hack.
Yeah.
It's a
So
real
let's
estate
say,
hack.
yeah, or even let's say, for example, you have a rental property, right? So the property taxes that you pay on that property doesn't go on your Schedule A. It goes on your Schedule E, which is almost like a Schedule C, right? SP,
Yeah.
that reduces your AGI. So then if it goes in there, there is no limitation on the, how much property tax or mortgage interest that you pay on your investment property.
So then we should
So
put our
that's,
investment property under an LLC.
Yes,
yeah, I mean,
usually
that's
the
it, yeah.
investment property. But Abby, to address it, that it is principal residence. Usually, I would say, okay, you put an LLC on it. You put it in an LLC to protect you if you're a business
Many
owner
lawsuits.
and you are having a business in your home, and somebody trips, somebody, then if it's an LLC, it might be a way of protecting them
Yeah, that's actually the main
from a
purpose
lawsuit.
of the LLC and the corporations is to protect your personal assets.
Yeah.
To protect anyone from suing you. So that's
Okay.
the main thing there.
Mm.
Yep. So, but then yes, for example, since we circled back on it, we went back to the if you have any rental or investment property, right? How it reduces your AGI. I kind of briefly mentioned that earlier. Like if you have a rental property, there's actually a lot of deductions that you could take to help you, pay less taxes. Because people would think like, oh yeah, I have a rental property, I'm going to be paying a lot of taxes. Well, not really. If you claim your rental property accordingly, it won't be that much of a hit. Or in certain cases, since you're paying a lot of mortgage interest, you're paying a lot of property tax, and plus you add in the depreciation, you actually kind of go in the negative, which reduces your AGI and in turn reduces your taxable income.
That's what our CPA does.
Mm-hmm.
That's why I'm like,
Yeah.
what is this depreciation schedule? But it
Yeah.
helps. It helps a lot.
Yeah. So the way that depreciation is, you depreciate the value of your, not the land, but the building, the house, by like 27 and a half years for like if it's a residential, and then you deduct that every year as part of your expenses for your rental income or investment property.
Okay.
And it really helps because what's good with the deductions with that is actually the depreciation are expenses that you never actually put any cash out.
Right.
You don't really you don't really spend money on it, but you're using it as a way to reduce your taxable income.
It's a standard number.
Usually for residential property, it's like 27 and a half years.
Yeah.
So let's say, for example, you bought a house for $600,000, but the value of the land is 200 and the building is 400. Then you divide 400 by 27 and a half years, and that's how much you could deduct every year.
Aren't there different types of depreciation that you can take on the investment property though? There's an aggressive one and
Yes.
there's one that's more conservative.
Yes. So there's a variety on it, and there's also depends on like what kind of properties that you have and how you use it. Then you could use whatever is most favorable for you. Then yes, you could do that. Especially with
I
like
do that for my car.
Section 179. You're referring to Section 179?
Yeah, I know
I
that.
don't know the section number. I just know it's like, oh, which one's gonna get me more?
Is it up to,
more of a
still up to
refund?
30,000?
It kind of depends on the property, but I'm not sure about the current limit
No,
right
on the
now.
car. Usually it's like 30,000, 39,000 or something.
Yeah, and I know it also depends on like if you want to do 100%, depends
Yeah.
on some of the weight
Sometimes.
of the car. I know there's a lot of variations on it. And if you guys contact me, we'll get into the detail.
Yeah.
Just to piggyback off on that, the comment you made about depreciation, how it's not actually cash you spent out, right? It's just
No.
it's like an imaginary number. So because I also write off the depreciation on my car, on my taxes. So for lenders, when they're calculating your DTI, they'll look at your AGI and they'll add back the depreciation as
Yeah.
kind of your income. So
Yeah, because they know that's not cash out.
there.
Right.
Yeah, exactly. And I'm glad that that they do that, because really it's not really money out of your pocket or anyone's pocket. Yeah.
So I have a question. So on average, because I noticed that my clients that don't own a home, they pay a lot more in taxes versus the ones that do own a home. So what do you think the difference is with as far as your tax refund or what you have to pay when you own a home versus when you don't?
Pretty much the Schedule A, which is your itemized deduction. Because if not, you're given what the government gives you, which is 24 and change, right? If you're married, filing joint. But then if you own a home, you for example, you paid $18,000 in mortgage interest. You paid $10,000 in property tax. Your deduction is $28,000 versus someone that's just filing, a standard of 24,000. So that means they have like $4,000 that got reduced, right? And also, if you are, except for this year, it was kind of like a one-off. But prior year, if you made donations, it doesn't, and then you're not itemizing, it doesn't really make an impact. But then if you're itemizing and then you add your donation will actually make an impact. Except this year, there was an exception because of the pandemic and the CARES Act, where you could deduct up to like $300 of charitable contribution. So those are the things. Yeah, $300 that you don't have to itemize, and you'll be able to deduct $300 of donations that you've made for 2020.
Well, what happens if it's more than that?
Then if it's more than that, if it's
not deductible.
Yes. If you're not itemizing, but then if you're tithing, that's way above than the standard deduction.
About 300.
I was going to say, SP, we should be donating out of the kindness of our hearts,
so,
not for the tax deduction.
Yeah, but then if you're tithing, that's more than
tax write-off.
Yeah. Yeah, but then if you're tithing, if you're tithing more than the standard deduction, and you have proof of that, then you'll be able to claim that along with like any state taxes you paid with your W-2, and and then that should put you over if you're actually tithing at a certain amount that goes over.
You see that?
Well,
Jason's watching. Jason Listina. Hi, Jason.
Hey, Jason.
Thanks for watching.
Yeah, I'm Malu Valdez came in. Oh, Oliver has another question.
Yeah, we're going to bring up all of that.
Yeah.
Sure.
Yeah, what did he say?
If I gave money as a gift to help a home buyer, is it taxed?
How much is a gift?
I mean, because like
13,000?
parents will give
30,000, let's say.
Okay, there. 30,000.
30,000. Well, technically, the person receiving won't be paying the tax. It's the person giving that'll be paying the tax. And then I think the limitations are $13,000 this year.
Okay.
And is it just to one person or two people?
To husband and wife.
Now, husband and wife, and then that will kind of extend it to like 26,000.
Okay.
So
if it's 250,000, if I have a client that gave $250,000 to their child so that they can buy a house, so that 250,000 is not deductible, or they have to pay tax on that, the parents?
Gift tax. But not on the 250. I mean, you'll have to deduct the 300 first. But then there are exclusions on it, and it gets into more detail. I know that if it's, let's say, to spouse, it's not. Yeah, but I'll have to sit, and I always like to look at the details. So just give me a call. We'll go through it.
How about for 401k? If you use your 401k for a down payment, is that taxable? Or do you pay a penalty?
So for the CARES Act, if you took it out in 2020, you won't be paying a penalty. And you could actually split, it's tax deductible as part of ordinary income. So what will happen is, let's say with the CARES Act, if you took it out last year, you could spread that income into 3 years.
Mhm.
Then you could, for example, you took out $100,000, then you could deduct. I mean, you could have $33,000 part of your income this year, the next 33,000 following year, and then the last year, the third year. So you could do that. But then let's say, for example, you're taking it out now, right? I haven't seen any provisions or legislations yet where they're going to do that the same thing this year. Then,
Mm.
for example, you're under 55, you're 40 years old, you took out $100,000. Then you're going to be paying like a 10% penalty. Plus, the $100,000 is now part of your additional income for the year, ordinary income.
Mm.
So then it'll be like $10,000 plus whatever income you made plus that one. So you might be taxed quite a bit.
Oh, because your income is going to increase. It's going to be
Yes, exactly. Your income will increase.
it's going to
So
be reflected as an income to you.
so you want to factor that into. So if you're gonna take out your 401k to buy your home, plan accordingly, and kind of calculate how much you wanna have how much you want to withhold already for the federal government and for the state taxes, so that you don't have to worry about it, or you won't get like a sticker shock right after.
Right.
Yeah, you don't want to get surprised with the big.
But if it's a first-time home buyer, remember, a first-time home buyer
Yes,
is
first time
somebody
home
who
buyer,
has not
different.
owned a house for the last
Yes.
3 years. They
Yes.
they may have owned a house 3 years before, but
Yeah.
3 years after, then you are a first-time home buyer. So first-time home buyer, then you still pay 10%.
Yeah. So there's an exception on the first time home buyer,
Mm-hmm.
but because I was just thinking what I've seen recently. But yes, there is an exemption for the first time home buyer, but you still have to pay the ordinary taxes that withdrawing will cost.
Mm-hmm. Mm-hmm.
So it will still increase for a lot of people. It increases their taxable income quite a chunk, especially if you're going to take out, let's say, 5 or 10%, like 10% of like a mortgage, a house now, what, $80,000. Then, for example, if you take out $80,000, then be prepared to pay taxes on that $80,000, state and federal, not just one, both.
So
Wow.
for us realtors, it's always good to tell our prospective buyer to talk to their CPA, just like Eric,
Yep.
before they pull out that 401k, right?
Yes, because the
Yeah.
thing is, you don't want them to to take too much money, and then once they settle in the house, they see their tax bill, then it's like, oh, then it'd be not a good situation.
Yeah.
Yeah.
Yeah, that's right.
Mhm.
So I have a
Yeah.
question. How do you
Sure.
stay on top on all the changing guidelines? Because
Actually,
you're like,
it's
this is new in 2020. I mean, the pandemic has given us everything new, right? And we've all had to pivot. But yeah, how do you stay on top of everything that constantly changes?
actually there's a newsletter that I would receive. Plus, on top of that, there's like a continuing education I always have to do every year.
Yeah.
So then I always have to like just read up on it. But I feel like I'm reading so much stuff that when I read it and then I look at the newsletter, it just changed. I was like,
Something
wait a
happened.
minute. But then it's only for this year. It wasn't like this from like the other years. It
Right.
seems like every other year it's
Yeah, there's
really
so many
much.
changes. Like that Prop 19, we did not even touch that. The Prop
Yeah.
19 that
Yeah.
replaced the Prop 1690, which
Yeah.
is getting a lot of you know noticeable now. People have been noticing it before. Which what replaced Prop 19 was the Prop 1690, and it also affected the Prop 13. You know, so those are things that are really affecting everybody right now, especially those who own properties that are more than just their home. You know,
Hmm.
yeah, yeah. So I guess we can talk about that in the next episode.
Yeah.
Um,
Actually, I'd like to pick your brain, SP, because I feel like you bring in a lot of knowledge also from like a different angle. Because I feel like my perspective is a lot from like my clients, which is kind of almost like in my circle. So
uh-huh.
then it kind of expands my knowledge talking to like the more people I talk to, the more people with different experience I hear. I feel like it kind of broadens my mindset in terms of like, okay, how do you approach your taxes? How will it benefit them? How will it not? So
Mhm.
yeah.
Yeah,
One of
well,
these
it's
days,
always
one
good
of
to
these
have
days,
this kind of group discussion
yeah,
and
we should
sharing
have
it
more.
to everybody. It might not be directly giving them information, but it can pick, their interest or
For
their
sure.
Exactly.
curiosity.
Exactly.
That's the main thing that we want to do. We're not really teaching everybody here specifically certain things. It's more on to pick your interest and to get more into detail, since everybody has their own uniqueness.
Case by
Then
case
that's the reason
situation.
why we have to call. You call us, call Jen, Abby, or even Eric here, and of course me.
Yes, of
you know
course.
Yeah, for more clarification, because
yes.
everyone's situation is
Hmm.
unique and specific,
Yeah.
so
Hmm.
that we can address your specific situation.
Yeah.
Yep. Yeah. You're right. Not everyone has the same cards.
Hmm.
Yeah,
That's how
for
I
sure.
see it.
Right.
Hmm.
Yeah.
All
And
right.
then
Well,
and then hopefully everyone has filed their taxes. If not, you guys could get a hold of me.
Yeah, we still have till
yeah,
May
You still have
7th.
room? You
May
can still
7th.
take clients? Aren't you super busy?
I still do take clients. Yes.
Well, it looks like Eric is young enough to absorb more clients.
Yes.
so there
So
you have it, guys. If any of you guys are homeowners, new homeowners, past homeowners, and have any tax questions, definitely reach out to Eric and he will help you with that. That wraps up our episode for this week. We will return back next week with him, and he's going to touch up on our tax benefits for your investment properties.
Yay,
So
can't
be
wait.
sure to tune in
Yeah.
next week. And until then, have a great night.
All
thank
right.
you.
Bye. Call us.